So it doesn't tell you very much. The market has treated this as a containable, temporary, and reversible shock, just like the US attack on an Iranian general, just like the attack on the Saudi oil production. That's how the market sees it. And it's supported in that view by nice comments about fiscal and monetary expansion. However, when you look at what's happening on the ground, David, it's completely different. You're getting sudden stops to various parts of the economy. It started in the province, it's spreading out. Now you're hearing companies in Europe and the US, Apple being the latest, having their supply chain disrupted. So I worry that the economic effects are not going to be a V. The hope is they're U, but there is a possibility of something worse than that.
It also affects both supply and demand. People are not manufacturing things, particularly in Hubei's province, but also Chinese people can't go to the store and buy things. They can't even get out, a lot of them.
Yes, and China, company after company, is now announcing that they may lay off people and not pay them. And the government is going to have to step in and save some of the more highly indebted companies. Absolutely. Like you say, and that's critical, it is both a demand shock and a supply shock. It affects trade and services. It is internal and external. So I think it's consequential. And it's not as if, as you know, that the global economy was in a great place to begin with. We got the data out of Japan, 6.3% contraction. Germany was stagnant. So I think for the economy, it's a bigger deal than it has been for the markets.
And yet, if you listen to most economic commentators, not just market people, but economic commentators, a lot of them sort of say, we'll get past the first quarter, we'll be fine into the second. If they are overly sanguine, why?
Because we've been deeply conditioned that that's what happens. I think that slowly, the markets have increasingly determined two things. One is central bank policy. So in the old days, it was central banks leading the markets. Now it's markets leading central banks. And I think now also, ironically, after analysts got the Saudi wrong, after analysts got the attack that killed the Iranian general wrong, that now the markets are leading analysts as well. Now we've seen it often in the stock market. This is the first time we see economic analysts influenced so much by price action.
So we have no idea how long it'll take to get back up and running in China. That could be some extended period of time. But might there be even longer potential ramifications? For example, if I'm a company, I'm relying upon Hubei province for my supply, might I think twice about really investing very much in Hubei province going forward?
Yeah, because if you're a company, you've realized what most of us know, is your strength can become your weakness. So global supply chains are wonderful, just-in-time management, cheapest production, etc. But when they get disrupted, they are really, really problematic. And I think increasingly companies are going to realize it's efficiency versus predictability. And that trade-off in the past has gone way too far in terms of efficiency. So I think you're going to see a revisiting of this whole globalization narrative.
Well, exactly, and globalization was not particularly in favor in some quarters, particularly in Washington, for example. Before that, you could say the same thing about Brexit. You could say the same thing in Europe. So there were already some questions being raised about globalization. Is there a risk, actually, this might move it further in that direction?
Yes, I think we as society pressed the pause button on globalization because we realized that certain segments were being left behind. That was the America First is exactly that. So that was the first phase of pausing globalization. The second phase is different, and it compounds the first one. The second phase is companies saying, wait a minute, this globalization has risks that we have to manage better. So I do think that we are not going to press play again on globalization quite as quickly. And then there's one thing in the politics. We have weaponized trade and investment policy. And once you weaponize trade and investment policy, you get conflicts between economic objectives and national security objectives.
Which raises a question of whatever the right analysis, V, U, L, W, whatever you use, what is the proper government response, whether it's Chinese government, U.S. government, other governments, either monetary or fiscal response? Is there anything to be done about it? Pumping more money into the system doesn't get the manufacturing facilities going in Hubei any faster.
That's absolutely right. And I think that markets don't distinguish enough between willingness and effectiveness. So I have no doubt that we are going to see one of the biggest correlated, lots of people doing it at the same time, fiscal expansions in Asia that we've ever seen. Put on top of that monetary stimulus, so we're going to have massive fiscal and monetary stimulus. But if you and I don't want to be in the same room together, if I can't source my products from you, it's not clear whether that's going to help. I think people have the model in their mind of the sudden stop during the global financial crisis. So we're two banks, we suddenly don't trust each other. Along comes the central bank with a printing press in the basement, says, trust me. And that's fine. But restoring production, consumption is harder.
And I have to come back to Washington a little bit right now. What will President Trump do? Will he say, go ahead and trust one another between the U.S. and China? Or might he take it the other direction? Because right now, we just had the conference over in Munich. And in fact, there were a lot of warnings from the U.S. side about doing business, for example, with Huawei.
Oh, clearly. If it's national security, the temptation will be to put more pressure on China. But the U.S. is facing a tug of war. On the one hand, China is a very important market. On the other hand, this is an opportunity that the U.S. has been looking forward. What I hear the most in Washington is the following. If not now, when? It may be too late. So we are going to see this tug of war play out between economic interests and national security interests.
A lot of uncertainty, a lot of risks right now because of coronavirus. When there's a crisis, there's also an opportunity somewhere. Someone once said, don't let a good crisis go to waste. If we were going to take advantage, if that's the right word, of this, let's face it, human tragedy, what could we do? What could we use this opportunity to do to say, okay, there's a reform we need to enact?
So first, let me tell you, some people are taking advantage already. If you are a producer of masks, you couldn't have dreamt of this situation. I think that smart companies and governments are realizing that there are at least 4 big themes coming together, and they've been fast-forwarded. They've been accelerated. One is deglobalization. That's been accelerated. The other one's climate change. If you don't take climate change seriously today as a company, your stakeholders are going to abandon you. And then there's this nexus between technology, AI, big data on the one hand, and privacy. And then there's demographics. So I think the smart companies are stepping back and saying, you know what, all these issues that were important but not urgent are becoming more urgent. And if we can get ahead of this, there are massive opportunities. And that's what I hear the really smart business leaders say. The problem is it involves self-disruption. And there's only a handful of companies that are really good at disrupting themselves.
Are you seeing leadership, either political leadership or corporate leadership, step up, really take a position and say, this is where we're going?
We're seeing it more on the corporate side than we are seeing on the political side. My biggest worry these days is in the US, is in China, is Europe, where you really do need leadership to step up. The ECB is either ineffective or counterproductive. Germany is going into recession. There is massive anti-establishment, and we haven't seen any major policy efforts at all to counter that. So government leadership in Europe in particular is urgently needed. This is not an engineering problem. This is a political implementation problem.
That was our special contributor, Mohamed El-Erian of Allianz. And let's turn back to our contributors right here on the set for their thoughts. So, Gillian, as we listened to Mohamed, it was a fairly sobering take on the underlying economy.
I think deeply depressing.
But at the same time, we've talked about the equity markets don't reflect that. And you have a fascinating piece out in the FT, actually, about the University of Michigan, my alma mater, their consumer sentiment on equities that are like way up.
Well, here's something that's fascinating. We had, obviously, equity markets hitting records this week in America. Donald Trump tweeting out best market in history. Here's one number I hope that the president doesn't see, which is the University of Michigan releases a consumer survey each month about where stocks are going. 66% of consumers right now apparently think that equity markets are going to keep rallying over the next year. That's up from 56% a year ago.
Which sounds good.
It beats even the 2007 boom. The problem is that, as Larry McDonald of Bear Trapp's report has written very astutely, every single time that index has jumped above 60 in the last 15 years, there's then been an equity market correction, ranging from 10% in 2018 through to 47% in 2008. So if Donald Trump starts crowing about or celebrating that number, the reality is it probably suggests we're heading for something of a correction.
So, Seema, what's an investor to do in that situation?
You need to sort of separate what's buy on the dip and what is get out of the way. And, I mean, we have those dialogues internally all the time with every position and across the portfolios. And so, look, it's an active debate. You have to focus on it when you look at these numbers, clearly. But going back to what Mohamed El-Erian was talking about in terms of economic reality versus politics, it's hard to parse through that now, especially what's going on in our country when you hear these tweets and see these tweets. So again, we focus on the long term. A lot of our big clients are long-term investors. A lot of them are U.S. public pension plans that invest over 30-year periods. So we look to think longer term. Valuations, if you think about it, aren't as stretched, relative to the past. And so again, we're just sort of monitoring everything that's happening, but there's no hand on the trigger right now.
And those pension plans, I suspect, are globally invested. So if you're trying to get some of the upside but not take the risk, what does that tell you? We heard Mohamed said that he thinks Europe is the biggest problem.
Yeah, so again, when I was the chief investment officer of the New York City Pension Fund many years ago, we had those conversations with our trustees. And you're right, we do invest globally and we invest over the long term. Emerging markets, we put a lot of emphasis on that. And again, you can argue that the last several years have not been great to be an investor in emerging markets. But when you think about the long term and where the growth is, even while China may go from 6% from Q4 of last year down to 4% in Q1 of this year because of what's been going on, what we've been talking about, it's still growing a lot faster than we are in a lot of parts of the world. And you look at India is going to grow even faster than China. And so, again, the valuations clearly have discounted emerging market equities, but does that mean you don't look at that as a long-term investment opportunity?
I mean, the problem is that in a world where rates are so low and equity dividend yields for the S&P 500 are higher than bond yields, where you've essentially got companies buying back stocks wherever they can because money's so cheap, it's very tough to stay out of the equity market. It really is, TINA rules large right now. There is no alternative. So I suspect this game can carry on for quite a long time. And there's another really important point that investors need to realise, which is that Donald Trump is tweeting about the stock market and the economy because he believes that's the best way to fight the next election. I would bet that after 2 or 3 years, when we've had all kinds of unpredictable moves from the president that have caused investors to panic on occasions, we're actually going to see that stop in 2020 because there is a reason why we now have a truce in the US-China war. I suspect we're going to see a much calmer message from the White House to keep the stock market high at all costs.
That's the one thing the president can control.
Exactly.
His own tweets, we think. We believe he can.
We hope so.
Yes, exactly.